Hey, welcome back to the Counsel podcast. Your host, Tom Tona. Before we jump into today's topic, I just want to take a minute to thank the sponsors of the podcast. This episode is sponsored by TonaLaw. They're not just another law firm. They're defining what it means to fight for their clients. We get a lot of attorney referrals from across the country. We pay fee participation in all jurisdictions where it's permitted. We focus on integrity, innovation, and relentless advocacy. TonaLaw is proving that the business of law can scale without losing its heart. If you want to see how a modern firm is built for impact and happy client referrals, check out TonaLaw.com. Mention again the Lead Counsel podcast, and I'm happy to get on the phone with you. I am joined today by Seth Deutsch. Seth is the founder of Samson Partners Group, and he created a system called the Exit Value Realization System, a framework that's designed to help founders understand how private equity evaluates a business for acquisition or investment and how to improve the value before a transaction. Seth has supported more than 150 deals, worked with more than 200 private equity groups, and helped create roughly $5 billion with a B in value across more than 20 industries. Seth, thanks for coming on, man. I really appreciate it.
It's a pleasure to be here. Thank you for having me.
So as we were talking before we got rolling, as I said, people that are paying attention in the circles that I'm in, and I'm in law firm masterminds, all of that, there's a lot of buzz and noise around private equity, what's going on in personal injury and private equity.
Yep.
I was like, let me go to the source. Let me call the guy. So your company is Samson Partners, right?
Yep.
Are you a investor, advisory group? What is Samson's role at any given time?
We do a number of things. We start typically with our clients. Well, it depends, but we advise founders is part of our business. So if you've heard of like EOS or Rockefeller Habits, those types of business systems, many of our clients are running those systems, but then a founder or a team reaches a point where they're thinking about maybe one day having an exit. And that can mean different things. That can mean they want to sell the business and retire. It can mean that they've hit a point in growth where they need to bring on outside investment. That could be from anyone. That could be from their brother, sister, dad, private equity, family office, friends and family, whatever it is, but they need additional capital from the outside. So they're thinking about bringing on a partner. It could be selling to private equity as a platform or as an add-on, whatever it is. We work with founders to prepare them for that. And what we teach in the book is, to think about preparing a business for an exit the same way you would think about a piece of real estate. Remove yourself emotionally from this. Every piece of real estate, you can go on Zillow or Redfin and you will know there's a known trade range, right? And we know typically the things that make up that value gap between $500 a foot and $800 a foot. By the way, if you live where I live here, where I'm at today in Chicago, I'm also not allowed to pretend like my home in Chicago is going to sell for an Aspen per square foot price, right? So we have to live within the realm of reality. And sometimes to get the type of transaction that we want, we might have to remodel the house before the transaction. We look at a business the same way, right? And so it can be founder risk, succession planning, key man risk, client concentration, operational leakage, all these things that maybe to get the exit that we envision, if that exit is within the realm of reality, maybe there are certain things we need to do to the business. So we kind of go arm in arm with our teams. We've got a team of 15 people. Everyone on my team has been a CEO or COO at one or multiple private equity-backed businesses that have actually had exits. I myself have had 5 exits in my career. I myself have done over 80 platform and add-on acquisitions. I myself sit on the boards of 6 private equity-backed companies today. We have been on the other side. We bring all that knowledge down to founders. The other thing that we did is we started an investment bank because our founders were asking us to then not hand them off to other bankers, but to help them then through the transaction. And then the third thing that we're just launching right now are a series of co-investment funds. So we only invest alongside of founders and their potential future private equity sponsors into deals. And we do this in various segments. But many of our founders and then the private equity sponsors, but especially our founders, want us on the cap table alongside of them on the other side of a transaction.
Look, I thought that was awesome. So, and what I forgot to mention during your intro, and I'll bring it up now, is the book that you authored, The Owner's Manual, Why, When, and How to Sell Your Business to Private Equity, I thought was awesome. I heard about it on a different podcast and I got sucked right in because it writes from the founder's view, like it addresses the different, I think your sweet spot is like first-time founders, right? If I got that right?
Yes. And what I would say is like you could be a multi-time founder, but it's the first time you're thinking about selling your business to an outside party, right? And in the United States, and we really wrote this for the owners of small businesses who don't necessarily have access to the type of knowledge and insight that larger businesses or people that are going to YPO or, that have access to Goldman Sachs or Morgan Stanley, these types of folks. I'm talking about mom and pop because, I grew up, my first house wasn't a house, it was a trailer. I don't come from anything. And, I've learned all this myself, and we don't want other founders to have to step on the rakes that we already stepped on. Right. And I remember when I first had the idea to write the book, it's part of a construction business that I'm the chairman of. And we were talking to some founders. They had a broker, and this family had come from nothing, 4 young children, small business, maybe about $500,000 of net income, completely untransactable. Basically 2 clients, and the entire business was running through the husband with the wife supporting and a few subcontractors. And incredible for them, but not something that an outside buyer could acquire. And the business broker had gotten their listing, told them all types of stories about what was going to be possible. And it was heartbreaking to have to sit there. We could have lied to them instead. My CEO and I sat there for 3 hours and explained to them that if at some point in time that they wanted to be able to sell the business, what they would be able to do. And, I've personally acquired 80 companies in my career, myself, my team, thousands. That means that I've probably looked at 3,000 deals. And we felt the need to take all of this information and bring it back to founders. And we also we shifted our team because our team used to be constantly consumed in contracting with and building businesses for private equity. That same team that has sat on that other side for so long is now available to coach founders and to help them prepare for this. So we work with companies big and small to help them basically what we call remodel the business before an exit. And this is what's really, really important. We actually just taught a class to the EO chapter of Chicago. As you go through that book, whether or not you ever intend to sell your business or not, if you practice the principles of the book, the business will become stronger, less fragile, more resilient to change. I decided to write that book in June of last year. That's when I had the idea, and we published in November. And I just kind of felt like it's a lived experience, and I felt just really compelled to share this. And I was also so blessed that 25 of my friends also contributed to the book. It's not just my words. It's from 25 executives who have been through what other founders are contemplating.
Look, that's why I thought it was so important. Like, again, as a typical founder, CEO of business, I deal with other founders and CEOs. I got a call this morning from a good friend. He's in your area, actually. I'm like, I got to connect you guys. Yeah. He's running a multiple 8-figure firm with a very healthy EBITDA, right? And, we're looking at what's going on and the speed at which the legal market's moving. Right. Yep. And I thought it couldn't be more timely because private equity is reshaping. They've already reshaped healthcare, accounting, wealth management, and now legal's in the conversation. And it should be. You knew it was coming. It was just a matter of when.
Yeah. And it's happening more than people realize, I would say. I think people are shocked when I say to them, for example, did you know that Blackstone now owns part of a law firm?
I did not know that. I did not know that, but I have a feeling because I had heard the rumor mill about one that got acquired out of Orlando.
Well, this is not even in that sector. Okay. Blackstone created, along with Bain and a few other very large venture capital firms, they were investors in Norm AI, which just spawned Norm Law. It's an AI native law firm. The former chairman of Sidley is now the CEO of an AI native law firm that is backed by Blackstone and Bain. Udea.
I just heard about that deal. Yeah, I just heard about that
By
deal.
the way, there are about 20 other AI native law firms that have been created in the last 12 months.
Right.
And people are just not paying attention. So everyone's looking over here at PI, which we'll talk about. But, I was the first person to bring traditional private equity into 2 sectors in the United States, personal injury and estate planning. The time that I was doing that, VSS, which is a fund out of New York, did a minority pref equity deal with a firm called S&A. And that is that sector is a sector that private equity now calls creditors' rights. Have you ever heard of creditors' rights?
Yes. Yeah.
I hadn't. I knew it as bankruptcy.
Right.
And debt collection. I knew it as debt collection, but that doesn't sound too appealing. Creditor's right sounds better than debt collection if you're talking to an institutional investor. And then Alpine was doing this in basically traditional corporate law with Briefly. years ago. So this was 4 years ago when we first started, to do this. Since then, my team has worked on over 20 transactions with private equity across 9 sectors of law just last year.
Wow.
Just last year, right? But yes, personal injury is the first space where we're seeing this happen in mass. And the thing that all founders need to understand is many, many founders in the personal injury space have already been experiencing what has happened through the nationalization of firms coming out of Arizona ABSs. But the other thing that, and I find it interesting that the industry doesn't talk about this enough, the industry has been working and scaling with private equity for much longer than this phase through litigation finance.
Right.
I mean, for gosh sakes,
Right.
Fortress manages 55 billion of private equity that invests in litigation financing. And so I find it quite interesting as some lawyers or whomever in the industry talk about, oh, this is so bad. But we've been using it for a long time in this industry, right, to effectively scale and to provide services to people that could not afford to bring these cases themselves. Right. But personal injury is definitely moving at light speed. I will be presenting at the Holland and Knight conference on April 16th. Conference is sold out. We got 100 investors coming to that conference. There are currently 22 family offices and private equity investors who have either invested in or are pursuing investments in the personal injury law space in the United States. And when this happens, as we write about in our white paper, so there's our book, Owner's Manual for All Founders. We published a white paper on this about a month and a half ago, 60-page white paper that describes what happens when private equity enters a space. You mentioned medical. So here we are, 26 years into the third evolution of dental service organizations in the United States. Massive market. 25 years later into the third evolution, 15% of dentists and dental practices are now owned by private equity through DSOs. So that means that it's a choice that people have. And so far, about 15% of the market has elected that choice. However, private equity coming into the market impacts everyone. It impacts how we market, how we procure, how we compete, right? And so I think that no matter what you do as a founder, this is not something that you can ignore.
Yeah, I agree. I mean, again, that's what I liked about the book is it kind of took the emotionality out of it, right?
Yep.
It demystified a lot of the noise that you're hearing out there. And so people are scared in general. Like I said, I talked to 2 multi-8-figure founders this morning and they started with, are you seeing what I'm seeing in the market? I was like, oh yeah, I'm seeing it. And if you're watching it, you should have concern, right? Because private equity coming in is changing the game.
Yep.
And now compound that with AI, case
Absolutely.
acquisition is changing the cost of case acquisition, all of it.
100%. And listen, it's been happening, and this is going to happen in every professional service. I mean, some of the industries that are most protected from AI, because I spend a lot of time in the blue collar trades, I am not concerned right now about my HVAC technicians, my welders, my plumbers, right? And my electricians being replaced by robots. They are physically moving atoms. I am not concerned about that yet. Now, AI is an enabler for us, but in anything that's a professional service, AI is coming at lightning speed. And so because of that, because of the efficiency that we can drive on the back end, right? And within PI specifically, there's very little key man risk in these scaled firms. Here's the one unique attribute about the legal industry in the United States is you cannot get non-competes on lawyers. So many of these firms that are already scaled, while the founders might have their name, image, and likeness associated with the firm, they haven't been running the firm day to day for a long time. Most of the other lawyers are employees. They're not equity holders. People come into the firm mostly because of marketing, not because of referrals. So if someone leaves, you don't have to worry. Depending on the time on desk, you could have firms that have anywhere between 10 months to 2 years of backlog, and in certain states, 2.5 years of backlog. And so what's happening is as firms are then taking on private equity investment, if they haven't yet reached a point of brand saturation in their market, or if they want to enter a new market with their brand, with the help of private equity, they can do that. Then they can use technology, AI, offshoring to make sure that they're ensuring, right, increasing the value of the case and decreasing the amount of human touch time. One of my clients has their own proprietary technology stack that we're infusing with AI in terms of total human intervention from intake to settlement, 3 hours of human time.
Wow. That's a massive compression. That's a massive compression.
It's amazing.
Yeah.
It's amazing, right?
Yeah.
And so the other thing is when we take a look at then what you can do with off-label, every brand hits a point of brand saturation at some point in time. And so you get to a point of diminishing returns, but then you can buy leads or buy cases, right, through off-brand digital marketing as well. And so the opportunity to scale these firms is incredible. The ability to apply technology and operational efficiency is fantastic. And then we take a look at matter types. It's a very interesting space. And so, what's interesting when this happened in accounting in the United States, actually the MSO structure that's used in accounting, which is now blessed by the SEC, was first uncovered in 2012. It took until 2021 for the first deal to happen. And in that first deal, 275 equity partners had to agree to the deal. Really, really interesting. Really interesting, right?
Yeah.
And now here we are 6 years later, about 1/3 of the top 30 accounting firms in the United States are now backed by private equity.
Really? Wow.
Yeah. It's happened that quickly. Now, the legal industry is massive. In the United States, we estimate it to be about a $400 billion industry. Personal injury, we estimate to be about $55 billion. Within that $55 billion, we estimate that there are about 50,000 PI firms. Within that, we estimate that there are about 1,500 that are over 15 million in net income. 1,500 that are over 15 million in net income, typically owned by one or two founders with very strong brands, very strong operations, et cetera. And so this is a market that is like designed for private equity.
Right.
It's designed for private equity.
So one of the things about your book that I loved, because the terror that goes through people in legal right now, when you mention private equity, is insane. And what I loved about your book was it just kind of takes it all down, the emotionality, all of it. Like, hey, listen, if you were selling your house, you wouldn't get upset, right? Like, and
Yep.
you likened it to the real estate equation with Zillow and all of that. And I liked the way you brought it down to that level of reality. Like I said earlier, it's weird how it timed out to get those two calls this morning. And founders are very concerned, not just about PE's entry into the market. AI combined with the 800-pound gorillas that I think I was reading in your PILA paper, that 50% of the market is owned by the top 20 firms, right? So if you're attuned as the CEO of a firm to the realities, then you just have to say, oh, it's coming. Like, it's already here. It's not even coming. It's here.
It's been here. It's been here. It's been here through litigation financing. It's been here through disbursement financing. It has been here through ABSs, right? Starting back in 2021. Right. And it's been in this segment for a while and it's accelerating. And what's interesting is I think that there's what happens in the room and then there's what happens behind the scenes, right? Because if it were so bad, if this were such a bad thing,
why is everybody looking at it?
why is everyone so in the back room so excited? Right. And what we see happening initially are what everyone's waiting for. And when I say waiting for, what's happening is certain mavericks are out front really wanting to go do this. And as you know, this industry is deep into what I call peer grouping or masterminding, right? And so what we're seeing happen is one of those founders is raising their hand and saying, I am going to be the first to go, right? And I'm going to show you that this is going to be a great thing. And then everyone, hey, come with me on the other side. And what we also know historically in roll-ups, what we call buy and builds in private equity, the thing we're seeking is called alpha, right? So private equity, and we explain this in the book and everything, private equity is a large asset class. It's existed for a very long time. At the end of the day, what is private equity? It's simply non-public person or people buying a business based off of that business's promise that it's going to produce future cash flows, right? That's it. It's existed for a very long time. It's now just a very, very big category because there's so much private equity available that companies now don't have to, let's say, go public. If you're a public company, you've got to worry about activist shareholders, perceptions in the public markets, quarterly reporting. I mean, you talk about short-term thinking, right? And so private equity gets to take a much longer cycle. But remember that who are the investors in private equity? These are pension holders. These are, the pensions of firefighters or teachers, or these are insurance companies. And when they invest in a private company and then you create value, you grow that company, you grow its earnings, whether it's organically, inorganically, et cetera. The only way that you can pay back pensioners and those investors in the private equity fund is to sell it again. One of my dear friends, Rick Gulliver, was one of the first to do an insurance brokerage roll-up. It became a company called Hub, H-U-B. Rick did his first private equity transaction in 1996, put together, a group of founders that wanted to go do this. It was about $50 million in revenue at the time. Here we are, 30 years later. Rick has had 8 private equity partners along the way. It's now a multi-billion-dollar firm.
Wow.
Every time they average close to a 3.5 times cash on cash return for their founders, and they just kept going again and again and again. So that is, private equity can be a beautiful thing. But, like any industry, there are good investors and bad investors. I know good lawyers and bad lawyers. I know good accountants and bad accountants. I know good priests and bad priests, right? Like, it's the world. Right. And the question is, for founders, it's like, what is it that you want to create? What's your vision? Right. There are lots of founders out there that take a look at a firm the size of Morgan & Morgan or Sweet James, and they're like, you know what? I want to be the next person to do that. There's nothing wrong with that ambition. Now, there are investors who could, because you may not be able to do that yourself with your own capital and with your own resources. And so just because that is something that a founder wants to do, we shouldn't get in the way of letting them do that. Doesn't mean it's for you or you. Back to the earlier point, though, what we know historically, as we take a look at returns, is that when founders, as they're executing buy and builds for the first time, merging companies together, bringing multiple firms together under one umbrella, when they have been peer grouping with those other acquisitions for a period of time, it means that a few things exist. Typically, shared operational playbook, shared values, common culture, respect, we like each other, we respect each other, a commitment to excellence, right? And so when we see these peer groups coming together, it's happened in dental, medical, HVAC, refrigeration, utility construction, you name any sector. When peer groups happen, alpha, which is the return profile, goes up about a turn.
Really?
Full multiple upon the first exit, because we have people coming together that didn't just meet through speed dating.
Right.
While they're coming together now in this transaction. So the way to kind of think about it, the first ones that are really happening at scale are basically now peer groups of shared ownership. These firms already know each other.
Yeah, it's funny because you mentioned EO. I became an EO member earlier last year. But one of the transactions that just had a massive ripple through the industry was the Dudley DeBosier transaction. And man, it just spread like wildfire. But also, he's got these masterminds that are part of his overall kind of, I think it's a playground, right, for those types of mindsets, the people that are building it as businesses. I actually am joining one of those masterminds because I am that builder that said, I look at the Morgans and go, I think what they've done is awesome. And then you have the lawyers, they always look down on it, right? Like, hey, listen, it's just a different business model. It's just a different belief system. That's all. It's not good or bad one way or the other, I think.
No. So this is happening in personal injury. It's happening in creditors' rights. It's happening in IP. It's happening in cyber law. It's actually we're now starting to see transactions that are going to happen in the AM law this year. We are seeing this happening in estate planning. People missed the Hargrove deal. That happened. Right? Like, it's happening all over the place, right?
Quick break to thank the sponsors of the podcast. This episode is supported by TonaLaw, a modern law firm built on integrity and innovation. Learn how they're changing the game at TonaLaw.com. Attorney referrals accepted from across the country. You'll see what it's like when you send us a case. You'll have some happy clients. I've been also hearing about family law.
Absolutely.
I've been hearing family law, which is interesting because I have several friends. And again, we're talking about the 8-figure to multi-8-figure firms. I know that you guys use a term throughout the book, lower middle market.
Yes.
Define that for people that are listening to this so they just have an idea of where the entry point is for your type of...
And we'll talk about, and there's a continuum of private equity, right? And there are firms that will play at different intersection points, right, within the capital continuum. Right. So family law is a really interesting example because there's really only one national family law practice. Then there's a super regional, and then it kind of falls. Then it's a collection of smaller firms. But family law investing, and by the way, I also remind people of this, and I'm going to get to your question. This is not the first time the legal industry has consolidated both in the public markets and the private equity markets. It's just happening here.
So, you're saying international?
Absolutely.
Okay.
And so we can take a look at the returns from public comps and from private equity data in terms of, where they have had strong returns. Two sectors stand out. Number one, personal injury. Number two, family law. And we'll get into those. But as we think about the market, there are private equity firms that can enter a market kind of at any point in time. And then typically a private equity hold period, traditional private equity is, let's say, 4 to 7 years. And then they could take the company public, they could sell it to a strategic, or they could sell it to another private equity firm, right? That then operates at a larger level, right? So, there are firms that'll enter a market with, let's say, 2 to 7 million of EBITDA. We have to define that for this audience. We'll come back to that, right? But let's just say, to keep it simple, post-compensation net income.
Gotcha.
Post-compensation, meaning whatever distributions you want to take, if you're not running it through the P&L, folks, I get it for tax purposes, but the cash that's left over after you pay yourself and everyone, okay, let's say 2 to 7 million of that, there are private equity firms that'll enter kind of at that mark. There are then other private equity firms that like to enter the market, let's say between 8 million to 20 million of EBITDA. There are other private equity firms that like to enter typically, it's at the $20 to $50 million mark of EBITDA. And then there are much larger firms that can enter at the 50 to 150 mark. And then firms like Carlyle and Blackstone and Warburg and Apollo who can enter, the market above there and even do take privates, right, of publicly traded companies. Many of the firms that we're dealing with today in the legal industry that are thinking about, entertaining conversations with private equity kind of fall in between that lower middle market, that let's say 5 to 10 million of EBITDA, to let's say 50, 60 million, of EBITDA, especially in the PI space, right? And then we have some much larger firms, some in the AM Law 100 that are today entertaining and working on taking on minority investment at the much larger end of the market. And so, what you're looking at doing, especially in the PI segment, which we know, these are well-established brands and their markets. Entering a new brand or a new market with an existing brand, that's really expensive, right? These are very highly defensible brands. Right. And so the idea is to pick, let's say, any private equity group that's looking at this is saying, okay, let's put together maybe 3, 4, 10 brands, right? We're going to keep those brands as they are in those markets. Now let's take a look at how do we create efficiency in the MSO? How do we create efficiency in intake? How do we create efficiency in CAC, right? How do we grow, right, wallet share in these markets? How do we then attack? Well, if we hit a point of brand saturation, then we can start to turn to off-brand, right, into lead gen. How do we together optimize all of this on the back end from a technology perspective using AI and other tools? And over time, continue to grow the firms organically and inorganically with the hope that, let's say 5 years from now, right, we can sell the company for a much larger multiple to either the next private equity buyer, or I'm speaking at National Trial Lawyers in Puerto Rico in May. The topic is who's going to have the first MSO IPO.
Wow. So let me ask you a question about that, because recently California came out with I don't know if it was an ethics decision or a ruling from the state bar. I heard it happened in Texas. I know it happened in North Carolina. Is there a concern about the recent attack on the MSO model? I have a belief system, but I'd love to hear from you about it. My belief is that where there's money, there's a way to figure out architecture. But what's your understanding and belief?
This is what I say to people. You have to talk to the ethicists.
Okay.
I'm a business person. I do not opine on this, right?
Okay.
So I don't cross those lines, right? But what I would say is that generally speaking, what we're seeing more stringent challenges to are things like co-counseling with ABSs, kind of banning co-counseling with ABSs. Here's the hidden secret, which is the tricky wicket with MSOs. They've been happening in the US since 2003 in the legal industry.
So why now is the states taking the stances that they're taking at the states that are doing it?
And what I would say is that in many cases, just to define this, and then you can, Holland and Knight and Lucian Pera and Crispin, all the ethicists out there can help you navigate these things. But what they're having what they can't do is ban them. Now we can make sure that these things are happening ethically, as we need to, right? Like every other industry, what's interesting where this happens in other industries, there's a national governing body or bodies that look after, because it's the same thing in medical, right? We don't want private equity telling the dentist or the surgeon how to perform medicine, right? We can't have, if you take a look at the CPA space, right? We cannot have an investor telling an audit partner how to issue an opinion on a publicly traded security, right? So there are ethical lines in all of these places. The reality is that MSOs in the legal industry in the United States and Canada, where it's also very prevalent, existed for a long time so that when founders were retiring, they could pass the firm without having to basically shut it down or liquidate it or sell it for under market value. They could pass them through trusts, through MSO structures to their surviving family members who are non-lawyers. That is the true history of MSOs in the United States. It's been happening for a very, very, very long time. So what happened here, the same way that it happened in the CPA space, is that then more traditional outside investors came across this thing that they did not create that already existed and existed pervasively.
Right. And listen, here's the thing in legal, and it's funny because, I'm 57. So I think about and talk about succession planning all the time, right?
Yep.
I have never seen a space where the people who do succession planning have so little succession planning that they should be doing, right?
And so few options to take what are pretty incredible businesses. It's the only sector until now in the United States where you really could not get, where I would say that fair market value was depressed because of the limitations.
Right. The licensing requirements, stuff like that. Right.
And I would remind everyone that the MSO, and again, go back to the ethicists, everyone, this was information to me. I didn't come up with this stuff, folks, right? Like we help founders. We were called into this industry because a group of founders in the personal injury space asked for our help. 4 years ago, we didn't know like this was, and so we just know how to help founders achieve what they want. And we also, because we've worked with 200 private equity firms, we know how to make sure founders don't get fucked by bad investors.
Right. So, one of the things I want to make sure that we cover and go over is, and again, you said it earlier, this book, whether you sell or not, is a guide to best practices for running a business. The 7 levers that you talked about, if you can just give us a rundown on the 7 levers, because it's really about predictability of cash flow, right? And so just give us a rundown of the 7 levers that you lay out, because to me, that was about as concise of my understanding about the 7 levers of profitability and growing a business best practices, but break it down for everybody that's listening.
Yes. So, the way that we kind of think about, enterprise value creation is thinking about a business through the investor's lens, so to speak, right? And so what we want, is that a business is what we call a business being anti-fragile, right? That is what we're looking for. And so if you can kind of remove yourself from the business and you think about this, and I say this to kind of, any founder, and there's the negative and the positive version of this. I'll start with the positive. You win the Powerball. You may be good, man. You're like, I'm off, right? And speaking to personal injury lawyers, right? You get in a car accident and you're disabled, right? You can't return to work, right? What might happen to your business if you have not constructed the business in such a way that it can withstand that shock, right? And so there are different things when we take a look at preserving and developing enterprise value. Number one is what we call vision and strategy. And it's not that you've got nice plaques on the wall,
right?
But it's that you have defined what makes your business unique, and that then those core values actually show up operationally in the business, that you have encoded your core values into the business and that we're able to see them flowing through the P&L. The next thing is really human capital and leadership, and basically making sure that at all the key lever points in the business that you have built redundancy or taking steps to build redundancy. Asking yourself the question, what happens if for whatever reason that person cannot come to work tomorrow? How much of the business, key decision-making, key relationships flow through the business? You want to take proactive steps to de-risk that, no matter what you're trying to do. Quality of revenue and quality of growth. Not all revenue is created equal. Here a big thing, and this doesn't really apply to personal injury, but we see this like in a lot of the blue collar businesses that I work with, or a lot of the manufacturing businesses I work with. Listen, for you, it could be a great thing. I've got buddies who are contractors, and 50% of their business is from one client. And that's been wonderful for them and their family. Wonderful. And when an investor comes in and takes a look at that and says, so 50% of the future cash flow is based off of this personal relationship, that is like, you may not be transactable, but if you are, let me tell you something, you ain't retiring after you sell it. You're going to be rolling a ton of equity, and you're going to be having like a 3 or 4 year earnout. Right? Because all the investor sees is risk.
Right.
So if you just take these lessons, but then think about that, what happens if your buddy sells his business and the new owner of that business is going to go through formal procurement and you haven't taken steps to diversify your client base, right?
I think what you just said is really important. I just want people that are listening to this to understand that you have to put yourself in the investor's shoes, right? Like as somebody, like I invest in real estate, a lot of attorneys invest in different things.
Absolutely.
What I want is zero or as close to zero risk. You want to protect that downside. So what you just said is really important, that you got to look at it from the investor standpoint. That's what I think is awesome about your book as well. You kind of look at it from both the seller's proposition and the investor's proposition. It's about bridging that gap between the two.
That's right. It starts with, and we write about this, and we've got a form on our website that people can download. All the tools, by the way, that we use to do this work with founders are free on our website. I challenged myself to write the book in such a way that if you read the book and downloaded our stuff, you might never need our help. If you do need our help, we're here. But I really wanted to help as many people as possible. But you're exactly right. And because look, like private equity buys 8,000 businesses in the United States every year. The market and the confluence and the partnership between private equity and private business owners would not be that large if it were so bad. Right. It doesn't mean that every outcome is great, but you know what? You can invest in a stock and you don't know what's going to happen. Right. So the other things are quality of operations. And this is, a lot of, obviously in the personal injury space, there's a lot of peer grouping, but a lot of, as founders, as they're thinking about investability, if you have operational leakage in your business, if you are not hitting your gross margin targets, right, your profitability targets, right, then this goes back to why is cash leaking from the business? If your business is, let's say, operating at 10% net income, but your peers are operating at 15% net income. And if you think about that from the investor's lens, what that signals to an investor is, well, we got problems here that we have to fix. Right. And so you may as well but if you can be achieving that level of profitability, you owe it to yourself, your employees, your families.
100%.
Just create resilience in the business, right? The next thing is the quality of your financials, right? So like financial reporting, but this is really, really important. So it's over time being able to tie, right, your operational metrics to your financial metrics, to understand those things those levers that really drive profitability in your business, to really understand like your financial cycles as well and your cash management cycles. But the tighter that we can really bring this, and then using that financial reporting to drive informed decision-making operationally in the business, creates strength. Right. The other two pillars, I won't go into great length, technology, data, and marketing, right? How well are you doing these things? And then the last one is really M&A. And this is really kind of for small business owners and a lot of private business owners, this may or may not be a thing for them. Right. But we teach a lot of founders, we work with a lot of founders and teach them how to do M&A themselves without private equity and how to do that properly. But I will tell you that if you've shown that you can do that, you can attract other founders to sell you their business. You can then integrate that well and improve the operations and the quality of other businesses that you have already acquired. That creates higher enterprise value for you. And it's a way to grow faster organically. But if you've done that, right, and then you're facing the market as someone that says, hey, I can buy other businesses and improve them, versus I bought other businesses and improve them.
Right. Now you can command a higher valuation because you're showing the deal history. You're showing the deal history.
Absolutely. Those are the 7 pillars. It's really that simple.
And I got to tell you that, again, my brain's been in this space now for about 2 years, where I know that Tom Linfesti is in the book. I'm on his law practice exchange. And a lot of it ties together with what you're saying. Like the first thing you talk about in that video on your website is, make sure you understand the way valuation valuations are done, right?
Right.
Like I was talking with Tom at one of the masterminds he was talking at, and he said, we're actually making people, in order to sell a business now, they have to go through the valuation process because I can't tell you the number of calls that I did. I know you guys do 800,000 attempts before you get to that 8,000, closings in a given year. The funnel at the top is 800,000, right?
That's
So
right.
it's a lot of work. I did call after call, and I'm doing back of the napkin math. I'm like, we need formal valuations. I can't even make this number math. You know what I mean? The
I
math
get
ain't
it.
mathing. So listen, and I do think that what you do masterfully in the book is you really humanize and make real. And I'm talking about, let's say at the lower end of the market, there are a lot of firms that are now trying to break that $10 million mark and their EBIT is very low. It may not even be the sweet spot. They may have to roll up with other firms before they even reach that critical mass, right?
That's right.
But there is a lot of opportunity there, I think, because a lot of founders my age are all in the same peer groups. And we are saying, look, there's got to be a banding together at some point if we're going to attract that level of interest.
And if you guys want, this has happened in other industries. What you are now thinking about, you're not the first ones to think about it, and it's been done. What we say, and law firms, by the way, have been merging together on a cashless basis for a long time. But if what you all want is to achieve this other multiple as opposed to getting attacked or picked off one by one at a certain valuation, band together.
I agree.
Merge.
I agree.
Right?
Yeah.
Execute it, prove it, right? Then together command a higher multiple. This is what private equity, by the way, is doing in the lower middle market and then selling the larger private equity firms. So a few years ago, we started to teach a class on that, how peer groups across multiple industries could emulate private equity, capture the value, then go to market. Right?
That's exactly the conversation I had this morning with one of those multiple 8-figure firms where I was like, listen, you would be platformed to smaller firms, bring on 3 or 4, all of a sudden you go from 30 to 60. That changes the math, right? That changes the calculation.
And then along the way, right, we've got to show, what did we do with culture? What did we do with integration? What did we do with marketing? So you can't just, back in the day, we used to call this a dog's breakfast. I can't just take all the stuff from the fridge and throw it together and be like, here now, look, I'm bigger, pay me more. Well, no, where's the value creation? Right? Actually prove out the value. Not necessarily take a long period of time, but that's a choice that founders have. And now that the market is evolving in such a way, you can now monetize that value creation. By the way, you mentioned, that you're part of EO in Long Island. We're happy to come teach a class. It was a lot of fun. Bobby Ashedu, a dear friend of mine, former chapter president of EO in Chicago, last week or 2 weeks ago, I can't remember how time flies. We taught our first class to the EO chapter of Chicago. I'm 6'7", which doesn't show up in video very well. But anyway, there we are. I'm wearing the world's tallest leprechaun t-shirt. Bobby allowed me to do that. But anyway, we took Bobby through this process in the finance and accounting space, and he's now part of Sikich, which is backed by Bain. And we shared his journey, which was the owner's manual before we wrote the book. It's just, it's how we've practiced for a long time. So we shared that journey over a 4-hour workshop with 65 members of EO here in Chicago. We are happy to take that show on the road anytime.
Look, I'll talk to the powers that be because I joined last year and it's been one of the most moving groups in terms of momentum and speed. And because I was in a lot of different masterminds, I kind of pared it down and it's been super valuable. They do these, like you said, 3-4 hour presentations. I'll definitely talk to the people in EO Long Island.
It's just to say to anyone listening to this as well, Bobby and I take the show on the road. I take the show on the road. We're doing another one for ACG, Association of Corporate Growth, which is another, nonprofit in Oklahoma next month. And one of the other things that I share when I teach classes, I share about the charity that I'm raising money for. This year, I feel just an incredible duty to help founders, and my whole team does, to share this knowledge and information. We did the best we could in the book, and there's more to come. And, whether it's through podcasts, whether it's through live learning, however we can help founders achieve what they want, it means so much to me. And I have a condition called complex post-traumatic stress disorder. And so I'm a product of severe abuse. And it's also part of why the personal injury market means so much to me. Actually, the first acquisition I was a part of is a firm in Canada that did historical sexual abuse, and I was sexually abused as a child. And so I'm raising money this year and donating all the investment banking that we do. I'm donating a portion of every mandate that we have to Mount Sinai. There's a gentleman, Dr. Jacob Ham, there who leads the Center for Complex Trauma. And so when I come out and teach for free, all that we ask is that if people got value, that they please donate to Mount Sinai to help those who have been abused. So for me, it's an honor and a privilege to be able to do this. For someone like me that suffered the type of abuse that I did as a child, to be able to do what I do in this life, I feel it's by grace of God. And so me and my team just, feel so fortunate to be doing this work. But when we come teach, we also spread that message, and we not only try to help others, but we also then ask that hopefully they donate to the cause that we're raising money for.
Absolutely. If you send me the link, I'll also put that in the show notes. A lot of my peers are actually handling those types of cases and litigations going on right now as we speak, in the mass tort space and stuff like that. So
Thank you.
My goal with this was to put the noise to rest and see that there is a very valuable function going on with private equity, right? Like, I don't think it's an evil thing. And there's such a misconception about it. I would urge anybody that's listening to this, pick up the book that Seth wrote. It's great because it shows it from both sides, right?
Yep.
It shows the humanity of a seller and why they would have the emotions they have, but also the reality of, listen, I'm a buyer, I'm an investor. Most lawyers are to some extent or another. And
That's
so
right.
you have to look at it from the other side standpoint to do a successful deal, right?
That's
And again, there's nothing wrong with selling your business to private equity. I think it should be more of a goal for more people, but not everybody will qualify for it either.
And listen, at the end of the day, it's a marriage.
Right.
And private equity is not forcing you. They can't come force you to sell your business.
Right.
You all are, right? Founders and buyers are choosing each other, right? And what we want to make sure is that really good marriages occur. But just like any industry, I mean, you go back to 2002, a friend of mine, his dad, Richard Lappin, was the first ever operating partner at Blackstone. And I've read his manifesto on value creation from then. And back then, there were about 120 private equity firms in the United States. Today, there are over 6,000.
Wow.
Right. And so, like, your choice as an owner operator, if this is a path that you want to go down for whatever reason, whatever's compelling you to think about this, whatever industry you're in, it's not like there's just like one choice. There are going to be lots of people, if this is something that you want to do, that you need to consider. But you really have to, I think, not view this as a transaction. If you think about that there is something that you want to achieve and you now need a partner, and what would that partnership look like? That's choice. Now, if you want to stay single,
right,
no one's judging you for that either.
I think in the smaller firms, there's a lot of that ego. I'm an island onto myself. I think as you either get older and more mature and wiser, you kind of say, well, look, I can only go so far on my own. I got to do this with a partner, like you said.
Correct.
Look, I want to thank you for coming on. It's been awesome. And
My
I
pleasure.
will go out to the EO people because I'd love to hear you speak again on it, in Long Island or in Chicago, wherever they're
We'd love
doing
to do it.
again. So,
Love to do it.
Seth, thanks again, man.
You got it.
Thank you for listening to this episode of Lead Counsel Podcast. Your host, Tom Tona. Go Anywhere Podcasts are distributed. Follow us. Leave us a 10-star review. Share some episodes with your friends. And thanks for listening. I appreciate it. Thank you. This episode is sponsored by TonalLaw. They're not just another law firm. They're defining what it means to fight for their clients. We get a lot of attorney referrals from across the country. We pay fee participation in all jurisdictions where it's permitted. We focus on integrity, innovation, and relentless advocacy. TonaLaw is proving that the business of law can scale without losing its heart. Do you want to see how a modern firm is built for impact and happy client referrals? Check out TonaLaw.com. Mention again the Lead Counsel Podcast, and I'm happy to get on the phone with you.